Good evening, everybody. It's Walter Montero here from Coldwell Banker and Mortgage Alliance, Maximum Results. Tonight we have a special guest by the name of Tim McNulty from Manulife Bank. We're going to be talking a little bit about the Manulife One product. It's a very unique product, and it's certainly not for everybody, but it's going to be a great tool in the right hands. And I wanted to make sure that we explained it properly, so I thought I'd get Tim himself to explain it for us. And are you there, Tim? You can take over there if you like.
Perfect. All right. Thank you, Walter. Thanks for having me, guys. I appreciate this opportunity. I'm very excited to chat about something I feel very passionate about, our Manulife One solution. A quick bio on me so the audience knows who is speaking. I am the business development consultant from Manulife Bank for the Cambridge and surrounding area. I have been with the Manulife family since 2001, and my wife and I have held the product personally for the past almost decade. We really appreciate the simplicity and flexibility the Manulife One offers and can't say enough about how fast it allows you to pay off your debt when used properly. Our partnership in the mortgage broker channel is something new, but it's also something exclusive. Not all mortgage brokers have access to this solution, but Walter's team at Maximum Results does, and they are a great resource if you have any questions. So our agenda for today, we're going to have a quick history on Manulife Bank just so you kind of understand the foundation. I'll go over the details of the Manulife One product and how it differs from other mortgages and what I think makes it better, and explain banking with Manulife Bank, just kind of generally speaking. Not a lot of people understand how that process works, and show some tools and resources that support my position. So without further ado, I'll go ahead here and Walter, chime in if you have any questions or see any from the audience.
Awesome, you bet.
So we'll start at the beginning. Manulife, we're a Canadian-based financial services company. We were actually founded in 1887. So we're a very old company. We've got very deep roots here in Canada. Canada's first Prime Minister, Sir John A. Macdonald, was actually our first president of the company. So kind of unique there. And we are one of the largest life insurance companies in the world. And we're known as a market leader in both financial protection as well as wealth management businesses. And we have more than 29,000 employees that serve our customers worldwide. That's usually what a lot of people resonate with. Not a lot of Canadians actually know we have a bank, however. Our bank, though, is a Schedule I federally chartered bank, just like any RBC or TD or any of the other big guys. The difference between us and them is that we work in a virtual capacity. We don't have any branches, and all of our transactions are done either over the phone or electronically. But this allows us to save on the overhead and pass these savings along to our clients in the form of a rate or maybe a niche product like the Manulife One. We do offer a number of loan, deposit, and mortgage products, and our Manulife One is the flagship for the company. So let's start there. So the all-in-one concept actually originated in Australia in the late 90s, and then it migrated to the UK under Sir Richard Branson. Manulife was actually the first Canadian company to bring this concept to Canada through the use of our flagship program, Manulife One. Now, this is not just a mortgage product, folks. It's a tailor-made long-term solution of income and cash flow. As Walter mentioned, it may not be something that every client can qualify for, but those who can really appreciate the multiple benefits it offers. So I'd like to start a little bit with how banking looks like for a lot of Canadians today. Most Canadians will have multiple accounts, and it really doesn't make sense. Using this scenario, we look at this client, and they have a number of different positive balance accounts, and maybe it's a checking account that they keep for their transaction, the cost of living, and they like to keep around $1,000 in that per month to cover the bills that go in and out. Of course, as it's a checking account, we don't earn any interest there, and we actually end up probably paying somewhere in the neighborhood of maybe $15 a month for those transactions. A lot of clients also seem to have a savings account, and for this example, I illustrated $2,000 in a savings account, and this client is only earning half a percentage point on that. And then I also decided, hey, these guys, maybe they opened up a tax-free savings account because they weren't sure what they're going to do with their money, and they've been shelling some money away into that, and they've got a balance built up of $2,000. And in this low interest rate environment, they're earning a whopping 1%. So we total up our positive balance accounts. We see these guys have a positive balance of $5,000. Then we look at the negative balance accounts. And for these clients, we see that they have a mortgage of $195,000. That's at 2.95%. Then we have a line of credit, and for these folks, it's $10,000 with a 6% interest rate. Maybe these guys also have a car loan, and they're just kind of finishing up some financing they got from a used car dealership a number of years ago, and $5,000 is our balance and 8.5% is our interest rate. And finally, maybe we also have some credit cards and we've got a balance sitting on that of $10,000 at 18%. Negative balance total, $220,000. And this is what it's like for a lot of people. But the biggest question we always ask, though, is why do you have a checking account? Your greatest asset is not your house. It's not your car. Your greatest asset is your income. And what do most people do with their greatest asset today? They put it in this checking account that earns them next to nothing. And the big banks love when clients bank like this. It allows them, not the client, to earn interest. You look at the spread on these different accounts. I mean, the credit cards, the banks are earning 18% on that.
That's
they pay
crazy.
next to nothing on your deposits. It is crazy. But we charge a penalty also on, or we charge plenty rather, on the credit. If you really think about it, it's almost like the client is giving their $5,000 to the bank and then borrowing it back in the form of these loan products. We just really feel it doesn't make sense. So we want to show clients that there is a better way. And we call it Manulife One. Manulife One, what we do is we set up this giant secured line of credit against the home, and we combine all these accounts into one simple product. So we offset the negative balance. So $220,000, we offset that with the $5,000 positive balance. And for these clients, it means they start owing $215,000. We also consolidate all of those higher interest rate debts down to one low simple interest rate of 3.20%. And because this is a transactional account, we actually charge $14 a month, but that includes all the client transactions, which I will speak about in a moment. So this really is the evolution of banking. Manulife One is the first and most efficient all-in-one account that allows the client to combine their mortgage, personal loans, lines of credit with their income and short-term savings. This process could save clients thousands of dollars in interest costs over the life of their debt. The first thing we do is we secure that line of credit against your home up to a maximum of 80% of your home's value, which any bank really can do. But then we do something that none of the big guys want to do. We let the client use this line of credit as a fully functioning checking account. Every time the client gets paid, and every time they deposit money into this account now, that money is going to go directly against the principal owing on the debt. Any amount deposited over and above the interest is applied directly to the client's principal balance. The account is revolving, meaning that clients can access funds from the account as needed up to their approved credit limit, which gives them much more control over their finances. Because an interest on a line of credit is calculated daily, the client owes less money that day and pays less interest that day. They will always be paying interest on a reduced balance. You no longer have any idle cash sitting in a checking account or savings account earning next to nothing. You maximize every penny you earn and apply all that money directly to your debt without giving up access to those funds should you need them later for maybe something exceptional, or maybe it's a vacation or unexpected expense. In essence, clients are now optimizing their greatest asset. And there's really three things that differentiate Manulife One from a traditional mortgage. With a traditional mortgage, interest is usually heavily front-loaded. You may get your year-end mortgage statement and go, holy smokes, it looks like all I paid this year was interest, especially in the early years. Number two, there are usually limitations to principal pay down. Some mortgages offer prepayments as high as maybe 25% of the original principal, but I find a lot of Canadians do not utilize this option when they have extra cash. They're afraid of losing access to it. For example, if I got a bonus of, say, $5,000 from work, I'd be afraid to put that down towards my mortgage prepayment option in case I needed access to those funds again down the road. Then I would get back into that cycle of either having to pay for that expense on a line of credit or a credit card. And then finally, when a payment is made to a traditional mortgage, part of that payment goes to interest and part of that goes to principal. Manulife One, this is all different. We charge simple interest calculated on the daily closing balance. Going back to my previous example here, this client we start charging interest on what that daily closing balance is, and for this example, it's $215,000 at day one. So every day that account sits at $215,000, we calculate that interest. We don't apply that until the end of the month. The second big difference between Manulife One and the traditional mortgage is there are no limitations on principal pay down. As you receive those higher cash fluctuations, you can deposit them, and we encourage you to deposit them into your account because that will save you interest. And then if you need those funds, you have the ability to draw them back because the account works like a line of credit. So say I get back to that example I was sharing earlier and I get a $5,000 bonus from work, I deposit that into my Manulife One, and my balance now goes down to $210,000. And it's sitting at $210,000 until I either draw from it or need access to that $5,000 again, and then I can pay it back. But once that money hits my account, it's been lowering the amount of interest I've been paying. The third difference between Manulife One and traditional mortgages that when payments are made, every penny goes against principal first. As I mentioned, interest is calculated daily but not applied until the end of the month. This gives the clients the ability to keep a lower balance longer. So again, looking at this example, this client starts their account with owing $215,000. Let's say, for example, they get paid $2,000 on the 1st of the month and the 15th of the month. So on the 1st of the month, hey, great news. We just lowered this account borrowing to $213,000. So from the 1st to the 15th, now I'm only calculating interest on $213,000 of borrowings. Then on the 15th, I get paid another $2,000. That now lowers my balance to $211,000. So from the 15th to the 30th, I'm now paying interest, or calculating interest rather, on $211,000. At the end of the month, we then apply that interest cost, and we start the cycle over again. There's even a way to kind of take this concept a little further, and that's through the use of credit cards. A lot of people like to have credit cards for reward programs today, and they use them wisely. And that's what I encourage with the Manulife One. Have all your regular day-to-day expenses, gas, groceries, cost of living, paid for on your credit card. That's letting you essentially use someone else's money all month long, keeping your Manulife One balance lower and thus saving interest on what we're charging. Then at the end of the month, again, we restart the cycle and pay that credit card off in full. The Manulife One would then go up by that amount. And when you really think about it, there's only two ways to pay down amortized debt faster. You can increase the frequency of payments or make lump sum payments to a mortgage. But with Manulife One, we're maximizing both concepts. We spoke about the lump sum payment functionality a moment ago and how not a lot of people take advantage of those prepayment options with traditional mortgage and how it's so beneficial with Manulife One. And you really can't get any more frequent than Manulife One as far as payments go. Direct your paychecks into this account, and then essentially you're using all of your money every day to pay down your debt. We help you take a very busy, inefficient model like this, which is common for the average Canadian. We get paychecks coming into a checking account, and then we have all these ins and outs and cash flow all over the place. We simplify things by offering a solution like this. All of the borrowings are in one account, and you always have a true picture of your net financial position. With us, clients get a monthly statement, and they can see exactly where they are and what they're spending every month. And we've gotten a lot of feedback over the years on how powerful our monthly statement is. So we're showing a client in black and white where they stand with their banking. Quick example of the statement here. So for these clients, we can see their maximum borrowing limit is $220,000.
Okay.
This $63,000, that's equity that they already have available to them. So maybe the kids are going away to university and you need to help pay with some tuition. Well, now you have the ability to do so. We don't have to go back to the bank and ask for funds if we've already built up this equity. We start with a balance for these guys. They only owe $158,578.25. That's what they're being charged interest on, not the overall limit. That's what they can go up to, but this is what they've used so far. For these folks, money goes into the account of $5,000 and change throughout the month, and we have expenses that come out of $3,343. The idea behind this is Finance 101. It's easy to say, sometimes tougher to do, but spend less than we make and we will see a reduction in our debt, and that's what this line shows us every single month. The statement goes on, and I won't dwell and spend a lot of time here. If you have questions, Walter's team is very excited to show you how this program works in detail for you specifically. The statement goes on to give clients breakdowns of all these values. There's a graph so the client can monitor what their borrowings are throughout. Because we have the ability, some people might not want to use a credit card and want to use this account exclusively as their transactional account. We have the ability to do that. Maybe we're writing checks or we're buying groceries or whatever the expenses are, and we're going to see our balance and our going up and down every single day. It gives the client the ability to do that. But enough about the statement. I'll jump back into my presentation. How does the Manulife One work? Well, it's comprised of a main account as well as which is basically that revolving line of credit, and in many cases a term sub-account. And a sub-accounts are an important feature of the Manulife One is they offer the clients the ability to divide debt up and kind of build some structure if the client has that need. It's almost like a mini mortgage within the Manulife One. This is how we can tailor the Manulife One solution to each individual client's needs, and I'll get into that in a little bit more detail in a few slides. Sub-accounts have a monthly payment, but that's made on the last day of the month directly from the Manulife One main account. So essentially everything's kind of talking together, and once you get this up and running, It really works very smoothly for the client. The two accounts work together. You don't have to remember to make a payment. So I mentioned earlier that there is a fee for this account. There is a flat monthly fee applicable on the account, and that's to cover all the transactions the client uses. Regular fee is $14 or $7 for seniors, which we would consider one of the applicants to be 60 years of age or older. Monthly fee is going to cover everyday banking transactions, such as deposits, withdrawals in Canada, debit card purchases, bill payments. Think anything you could do with a checking account, you can do with your Manulife One. Email money transfers is another one that people ask about. There are some fees that may be applicable if the client uses the account for exceptional purposes. An example of that may be wiring money to Europe. There's going to be a separate charge for that because that's not a common transaction covered under that $7 monthly fee, but it is something that we do have the ability to offer. So as a virtual bank, we don't have any bricks and mortar branches to maintain. Our clients transact with us using mobile, internet, or telephone banking services. In addition to this, we're also part of what's known as the Exchange ABM network in Canada. This is the only inter-institutional full-function ABM network in Canada. Basically, in layman's terms, what that is when we developed the Manulife Bank brand, we looked at the landscape and said, does it make sense for us to have our own ATM network? And if so, what's the cost associated with that? And of course, the cost was astronomical. So we looked to the market to say, who else is in a similar situation as us? Could we partner up with these other institutions to maybe share these infrastructure costs? And that's what we have done. And this is called the Exchange Network. And I'm just going to bring up here really quickly from the website. Can you see that there, Walter, the map?
Yep, map, yep, I can see it.
So this is basically a listing of the Manulife shared network. And I just typed in, find an ABM in Cambridge and show me what machines are on the same network as us. And as you can see here from my right panel, it's a number of the smaller banks or credit unions.
Mm-hmm.
The Education Credit Union on Water Street, downtown Galt. If a client of Manulife Banks went in there and used that ATM, it would be just as if they were an Education Credit Union client. Similarly, if that Education Credit Union client came into a Manulife Bank ATM, they wouldn't be charged any service fees either. They'd be considered one and the same. Now, the people online will also probably see a number of these Manulife Bank branded ATMs, and these are all located in Max Milk convenience stores. Max Convenience in Ontario and throughout the Midwest, Circle K down east, and Couche-Tard in Quebec. We actually just added 700 ABMs in these Max Milk variety stores, and that plus the already existing reciprocal agreement we had with these other banks and institutions makes us collectively the second largest ATM network in Canada. So it's pretty impressive. So what's our niche market for the Manulife One? I would say it's any client who is solid from a credit perspective and has at least 20% equity in their property. It's not something available for the high ratio client. Now, whether that's clients looking for certainty or flexibility, maybe a longer amortization or shorter amortization, or want to take advantage of fixed or variable rates, the great news is that the Manulife One solution can adapt. As a client's needs change over time, Manulife One can really evolve with. In the past, I personally have seen kind of three main client types. Number one is the client who wishes to pay off their debt as fast as possible. Maybe they're consolidating, kind of like my example earlier. Number two could be clients that have little or no debt but want to establish the account for where life might take. Maybe that's home renovations or helping the kids with school, using the equity of their home, taking that trip of a lifetime, or maybe it's just that ultimate what-if account. And then finally, another big segment where I've seen clients get into the account and maybe they just don't have enough saved for their retirement cash flow requirement. And they're looking at qualifying for something before they retire, and this might be the best product for them because of the way it can be used. So I talked earlier about how we would customize this, and Walter's team would work with you and the clients to build a solution that is the right mix of the all-in-one, the line of credit account, and those sub-accounts, those amortized balances. And this would be from an assessment of the client's income and lifestyle, cash flow surplus, or if they tolerant to different interest rate spikes, or managing good debt or bad debt. Walter's team would build this solution for the client based on the assessment of these factors. And I think, in the past, some people have had this misconception that Manulife One is not a product for all clients because of the fact that it's all a line of credit, and that's not the case. And this is what I was talking about earlier about tailoring to the solution. That's a big myth. For some, it might make sense to have most of the account as a line of credit, but for others, it might not. And that key is finding that right mix, create the behavioral path that will help the clients. So maybe for your low cash flow clients, maybe these are two folks that salary goes up by 2% annually, kind of matching what our inflation rate is. They probably don't have the cash flow to benefit from an all-in-one product like the Manulife One. So maybe we fix most of their debt into one of those sub-accounts, but we leave a decent chunk in the line of credit. So they do have some flexibility for wherever life's going, or maybe helping the kids, or whatever that expense might be. But conversely, maybe the same product can be offered in a completely different way for the self-employed individual. Maybe it's a landscaper who makes a ton of money in spring, summer, and fall, but in winter chooses not to work. Well, in those high cash flow seasons, they can take that money and pay it down on their principal very aggressively, erase the debt if at all possible, but then draw it back and borrow it back during that off. Work with whatever the client's needs are and build the product solution to fit them. The key is to understand the cash flow, the debt goals, the future income, the budget surplus, and build it to the right mix. And that's what Walter and his team will work so hard with you on. So a few resources now. We've got a number of tools out there, and like anyone, when you are investigating a solution, I recommend reading some reviews and see what else is out there on the internet. Take it with a grain of salt, because we know the internet's not always true. But we have a calculator, and this is something, again, that Walter's team would be able to help show you and would be happy to walk you through. And we take a case study from this calculator. What the calculator is going to do is offer the client to enter a number of different inputs, or the mortgage broker to enter a number of inputs. And it's going to compare the traditional banking mode versus the Manulife One model to see if there's any benefit. So for these clients, we are looking at comparing the Manulife One solution to the need of a $300,000 mortgage, and we're competing against a 5-year fixed term of 2.64% that's amortized over 25 years. So that mortgage cost, if the client was to go that route, their monthly payments would be $1,365. But in comparing to the Manulife One, Walter's team is going to do some digging and talk to you a little bit more about your cash flow and what your finances look like. And we're going to say, okay, you know what, let's see how the Manulife One completely open line of credit would look for this client. What are our interest costs going to be? Well, comparing to the traditional mortgage at 2.64%, the interest cost over the 25 years for that is $109,004. The Manulife One solution in the completely open line of credit ends up being very similar, $108,801. But this is the big difference here, folks. In the traditional mortgage, the client has chosen to amortize that debt over 25 years. In the Manulife One solution, having everything in the line of credit, using all of your money to offset your debt every day, ends up taking 20.8 years, just shy of 21 years to pay off that debt. Mm-hmm. That's payment freedom 58 months sooner, or savings of almost $80,000. But we know some clients, they might not have that interest rate risk tolerance for a variable component like the Manulife One. So again, this is where Walter's team might have some further conversations with you guys and talk about how we can really customize the product. And maybe that means we do a kind of blended solution here, where we offer $200,000 of the Manulife One debt in one of those sub-accounts. Because this client, they want to get out of debt as fast as possible, we're going to amortize that over 20 years, and hey, great news, we match that rate of 2.64%. So our required payment there is $1,072. But the rest of the money, the other third, the $100,000, we leave in the line of credit, because we want the client to have the ability to pay that down very fast. So what does this solution look like if the client follows the plan? The interest cost, again, over the 25-year AM mortgage is $109,000 and change. But the Manulife One is greatly better. Amortized over 20 years, the $200,000 ends up costing $57,300 in interest, and it takes 20 years to pay off. And the rest, the other $100,000 in the 3.2% line of credit, takes slightly less than 20 years to pay off and has an interest cost of $34,000. The total interest cost ends up being $91,345, and that's an interest savings of $18,114, and the client's debt 5 years sooner. Debt-free, rather, 5 years sooner. I think what we try to illustrate with the Manulife One solution is that the lowest interest rate doesn't always equal the lowest interest paid. Manulife One gives clients the ability to erase their principal very aggressively when used properly, and that is key. Interest rates really only matter if there's a principal to charge it on, and that's how an interest cost is derived. This gives the client the ability to work within their cash flow to erase that principal and get out of debt faster. So it's great to hear from me. I'm the Manulife One representative for the area, but like I mentioned, folks, do your time investigating, have a look around, check with the references. We were very proud. We were actually part of a Money Sense magazine article a number of years ago that talked about the 50 great ways to grow your money. And if you're not sure of the Money Sense magazine, I encourage you to Google that one. You'll find that this is a very reliable source in the Canadian marketplace on all sorts of monetary issues. And in this article, in the 50 great ways to grow your money, they actually reference a number 25 to consider Manulife One, product which merges your mortgage with a line of credit and a checking account. Any cash you deposit immediately reduces your mortgage total. Any check you write adds to your total owing. And the result, you never have idle cash flying around. So that's it for me. Walter, maybe I'll hand it back over to you.
Okay.
I don't see any
Excellent.
questions here, but
Okay.
I thank you for having me on this webinar. And I encourage the group, if they have further questions, reach out to you and your team at Maximum Results. I'm here for further assistance through you guys if needed, but you guys are the experts as well, and it can certainly help the clients.
Awesome. Very good. Thanks a lot, Tim. There are a couple questions that have come up. There's one of them was with regards to when you had made reference to the seasonal workers. So you had mentioned that, the cash flow is obviously a little higher when the seasonal workers are obviously working. When they're not working, is there still an actual payment that goes towards their exhausting their debt, and how does that work?
Sure. I can certainly speak to that. So because this now is our fully functioning account, the interest is going to still be applied even though we don't have any cash flow coming in. But the great news with those seasonal workers, or at least in the example I described, they've built up this giant cushion. They've now got a ton of equity they can draw from their account, so they can just simply let their interest capitalize.
I see.
And that's what I see quite often will happen with those seasonal workers, is they'll take that opportunity to drive the debt down quickly, knowing that in their slower months, they're just going to let it compound and increase. And then when they get back to work, they drive it down very aggressively again.
I see. Okay, well that's pretty neat. And now with regards to sub-accounts, is there a limitation as to the number of sub-accounts somebody can have?
Yeah, so I can certainly speak to that as well. The Manulife One account offers one sub-account to start. That's setting up through you and Karen and the team there. But once the account has actually opened, the client can then add an additional 4 other fixed-term sub-accounts. So essentially, they can have 5 fixed-rate term sub-accounts in the Manulife One at any time.
I see.
And another thing I didn't get into too much detail on in this presentation, because I was trying to keep it somewhat simple, was the fact that we also have the ability to set up what we call as tracking sub-accounts. There's no terms and conditions to that. It's just the same rate as the main account. But what it does give the client the ability to do is track some of their debt separately. And it's just saving having to get out that Excel spreadsheet and say, okay, I owe $200,000 on my mortgage, but I lent the kids $20,000 to go to school, and I want to know what's the interest on just the $20,000 every month. You have the ability to set up to 15 of those within your Manulife One, open and close them at any time, name them whatever you want, and that is something that the client can also do.
Okay, all right. Okay, and another question is with regards to the property in which you can put the Man One product on. Is it just limited to your principal residence, or can you put it on rental properties, for example?
So right now it is the principal residence.
Okay.
Now what we do have the ability to offer the client is it can also be a secondary residence like a cottage.
Okay.
If it is on that secondary residence, that property would be reviewed in our underwriting team just as if it was a primary residence. So that vacation property has to have year-round road access, has to have a heating source, a water source, basically mirror the characteristics of the primary residence.
I see. I see.
Investment properties, that's a great question. Can we do it on rentals? It is something that we're looking at developing and having available in the mortgage broker space. Being told later in 2017, we're just not there yet.
Excellent. Excellent. Okay. Well, I think that's it for questions for now. And yeah, this is a really great product. I can see how somebody can use it and really exhaust debt. I know we were talking about it in the office the other day, and you know, traditionally people have that, that savings account that just kind of hangs in the wing and never really does anything. Now your savings are really exhausting your debt, and of course with some discipline, obviously, you can really hammer down that debt load really quickly.
Absolutely.
Awesome. All right. Well, thanks again for your time. Obviously, I've got up on my screen our contact information. Obviously, you guys can call Karen or myself here at the office. You can contact us via email or call us right on the telephone. If you want to go online and just do an application, you can go to our site that goes directly to our mortgage application, which is www.homepreapproval.com. You'll see my wife's beautiful face in the corner, in the right hand corner. Fill out the app. Make sure you make a note that you're especially interested in the Manulife One product, or you can just go right through our website, which is mrfinancial.ca. So again, thanks very much for your time, Tim, and everybody. Thanks for showing up tonight.
Great. Thank you, Walter. Thank you, everyone. Take care.